Hey guys, welcome back. I'm Zack from Home Life Green Team Realty in Sudbury, Ontario. And today we're going to be looking at time horizon in real estate investing. So, time horizon, why is it important and what does that mean? If you just look at the first word, so I'm going to switch to orange. Look at the first word here. Time horizon is all about how long you own a property, how long of a term you plan on holding a property when you buy. And this can be fluid, this can change. You could buy a property originally thinking it will be a flip or a short term, and we'll go over what that is. Or, as you own the property, you realize it's a great one, you want to keep it long term. So these things can change. Generally, there's going to be three time horizons, and those are going to span from what I would call short term, and then you're going to have intermediate term. I'm just going to write these all in red. Intermediate, which is a long way of saying middle, and then there would be long term. Long term. So I'm going to go through each time horizon first, or each one at a time, rather than jumping between them, because I think just going over each of the points will be a lot more comprehensible, will be a lot more understandable. So why is this important? Well, because each of these time horizons has a different appeal for real estate investors, and each one is going to yield different results. Depending on what you're looking for, what you need, what benefits you're looking for, each of these will offer you a different benefit. So when you think about short-term rentals, I actually have three different colors just so things can stay easier to understand. So I'm going to start with blue for short-term, and I'm not using any particular color for anything. And hopefully by the end of this video, you can figure out what kind of real estate investor you are going to be or already are, and hopefully everyone can take something away from this. So the first thing with short term, the first thing you're going to hear is flips. Flips. So what's a flip? Why is it called a flip? So a flip, and first of all, let me define short term. So short term real estate investing is going to be anything that's under 1 to 2 years. Anything that's under 2 years. Typically, you'll see these, sometimes it's as short as 6 months, but sometimes as long as 2 or even 3 years on kind of the stretched out, the longer short-term holds. And then intermediate is going to be 3 to 5. Long-term would be anything over 5. Sometimes long-term real estate investing can go generations, right? Can be 100 years. And obviously you wouldn't even reap the benefits of that. That would be more of a generational move than a personal gain. And you'll see me looking down just because there's so many points. I didn't want to miss anything, so I've written myself some notes. So let's talk about flips. What is that? So a real estate flip, you've probably heard this term before, unless you're just getting into real estate. Essentially what that is buying a property with several criteria. Generally they need to be either underpriced, or the property needs to be in bad condition, or the property needs to be kind of the cheapest property in that neighborhood for the reasons I've already listed. And you're going to buy that inefficiency, you're going to buy that property at a discount and then sell it for what it's really worth. You're going to buy it lower than it's worth and sell it at what it's worth. I don't typically recommend trying to sell things for more than they're worth. That would be entering more into the scam, kind of taking advantage of people section. So I think you should always, for instance, if you're going to be a short-term investor, and most real estate investors at one point in their career will dabble in short-term investing because it's very profitable in the short term. What you need to realize is it's not sustainable to sell things for more than they're really worth. What does that mean? What does really worth mean? In terms of real estate, there's many ways to value a price of a property. But in general, what something is worth is what someone is willing to pay. So by that definition, it's impossible to oversell something. It's impossible to sell something for more than it's worth because if someone's willing to pay it, that's what it's worth. But I guess what I'm trying to say is putting lipstick on a pig and selling it is not a good practice. And if you want to do this long term, even if you want to do short term, but you want to invest over the long term, I wouldn't recommend trying to sell something for more than it's worth. So flipping, again, the key to flipping is buying something under market value. And that is possible. It's always possible. So the real kind of nitty-gritty of flips is improvements. Because if you buy something underpriced, it's priced here, but it's worth here, there is a differential there. And to make up that differential, the easiest way is usually through improvements. Because real estate is property, you can't move the property typically, so you can't put it in a better neighborhood. But what you can do, and what you do have control over, is the condition. So sometimes it's as simple as new paint, doing some trim, repairing some holes, and then putting some shingles on the roof, and the property's ready to sell again for a great margin more than what you bought it from. Sometimes it's simple. Sometimes these improvements are very, very drastic. Buying something vastly under market of what it would be worth if it was fixed up, and just doing an entire gut job. Gut job just means just taking out everything down to its studs and starting from zero. So I already mentioned this, but another key to short-term efficiencies is taking advantage of market inefficiencies. And I've already mentioned this. Buying something under market value means that you're taking advantage of an inefficiency. What's an inefficiency? If you think of a machine, large machine with many gears and cogs all turning, they all have a job to do. If one of the cogs isn't turning, in this example, that's an inefficiency. It's cutting against everything else. So in real estate, if a property in a made-up neighborhood should be worth $200K, but you're seeing one for only $150, that's an inefficiency. Because in a perfect world, every property of a similar description, with the same bedrooms, the same bathrooms, should be worth the same. So if you're seeing one that's vastly underpriced, that's an inefficiency. Some people will disagree with me on this and say inefficiencies have to be circumstantial. So just because something is priced lower than another, in the exact same category, doesn't necessarily mean it's an inefficiency. The way I define it is anything that should be priced higher but isn't, you can take advantage of that in short-term investing. And I think we'll go over more inefficiencies in a second. One of the kind of pullbacks or one of the disadvantages of short-term investing is you will not benefit from appreciation. What's appreciation? Appreciation is the intrinsic meaning built in. It's the intrinsic benefit of real estate that it will increase in value over time. That's for a multitude of reasons. One of them is inflation. Our currency is constantly being devalued. Each year it's worth less. To buy the same thing, you have to pay more, right? And we expect that. But that's not the only thing. Appreciation is also because there's scarcity. Anytime that there's scarcity of a resource or a commodity, and the same number of people want it, there's going to be appreciation because they'll compete more and more voraciously for that same place. I think, if you've gotten this far and you're watching this video, you probably know what appreciation is. But you will not benefit from appreciation typically in the short term unless you've timed the market really, really well. For instance, in Sudbury this year, as in it's 2021 when I'm recording this, as of 2020, the market jumped, in some neighborhoods as much as 20%, which if you had bought just before that jump, timed the market like in stocks or any other thing, you would see a 20% gain in just a year doing absolutely nothing, which is absolutely crazy. And I think in another video we'll go over market timing, but for now I think that's probably good. So another kind of Another kind of disadvantage is the tax disadvantages. So what do I mean by that? Mainly I'm talking about capital gains, and in some cases, especially in Ontario, you're talking about personal income when you do improvements to a property and sell it. So personal income is the least favorable of the taxes. Capital gains is a tier below that. But generally with short term, even if you live in the property yourself as your primary residence, you won't always be able to claim the tax, I'm blanking on the word right now. You won't always be able to deduct the taxes when you sell the property. That doesn't mean you're paying, HST on the sale of property. It means at the end of the year, when the Canada Revenue Agency comes for you, they're going to wonder, why did you get all this money, and we want to take our part of it. So there is that disadvantage with short term, but maybe at the end of the video I'll go over why that's not always a bad thing. Sorry, the tax disadvantages are always a bad thing, but why short term isn't always a bad thing. So I've already mentioned flipping and improvements, but now let's talk about lending. So this is another disadvantage, but it can also be seen as an advantage for investors. So typically with short-term loans, lending is going to be a little bit tougher. And why do I say that? You could just go to a mortgage broker or a bank and say, I want to live in this house, please give me a loan. And that will be something like a 25-year mortgage with amortization of 5-year periods. But in short-term lending, that's not typically what you want. Why is that? Well, you're going to run into penalties with typical mortgages, selling the property, which means getting rid of the mortgage early. Those penalties can range, but typically about 1% of the value of the property, which if it's $1 million property, that's a $10,000 penalty. Not exactly fun to absorb that. That could really eat into what you're trying to do. So typically you're going to have to look for private lending and maybe no principal payments lending. So we've talked about this in other videos, but every loan, well, not every loan, but most loans, there's an interest portion, which is the part the bank makes for loaning you the money, and there's a principal portion, which is you giving installments to the bank to pay back that original loan. But in this case, and if you get on with the right people, or get on a good, what I would call a first name basis with a mortgage broker or banker, you might be able to start benefiting from no principal short-term loans. And in that case, they give you the loan for your property, $200,000 or $300,000. Let's say you do the work on the place, and then again, hopefully you can get away from this penalty if you know the people, because this is more of a short-term loan anyway. And instead of paying principal and interest, which principal can really add up, because you plan on paying it off early, you just pay interest each month on that loan. Now the interest will be a little bit higher than for like a fixed rate 25-year mortgage, but it's still going to be much less than if you had to pay both principal and interest. I'll probably come back to short term as I remember more things, but let's move on to intermediate. So intermediate, what are you looking for? Typically with intermediate, you're looking for upward market movement. Why is this? 3 to 5 years is not really enough time to start really benefiting from a large cash flow. Though cash flow is the best, cash flow only really applies in intermediate and long-term loans. In short-term loans, the amount of cash you're going to generate in just 2 years is not as much. Generally, we're talking about for rental income, because if you rehab a property, sell it for $100,000 more, but you would have cash flowed $15,000 or $20,000 by having renters in that building, it's just not going to be worth your time. You'd rather focus on improvements than just getting rental income. Whereas in intermediate, your focus starts to be more on returns in terms of rental income rather than simple just improvements and flipping. So when is this a good strategy to do? Like I've said, upward market movement. So if you suspect that the market, you can't really time the market like in the short term, but you know in the next few years something good is going to happen, intermediate is the best way to go. I know lots of people that have bought properties in the last 3 to 5 years here in Sudbury thinking, you know, the market is good here, it's appreciating maybe 5 or 10% per year in the multifamily sphere, which maybe in another video I'll go over that as well, for Sudbury specifically, because that's the market I know about. But they don't know exactly when it's going to happen or when there's going to be a jump. So this is perfect. They buy something, again, with an intermediate loan, you can buy more of a typical mortgage, or you can apply for more of a typical mortgage because you're planning on holding it the entire period, the entire 5-year period of a 25-year mortgage. And like I said, this is, you know, the most effective when you suspect upward market movement. Also effective in long term, but in long term you're not planning on selling basically ever. So upward market movement doesn't necessarily benefit you because what the property is worth doesn't affect you after you own it. So what causes upward market movement? I already mentioned it, but it's essentially when demand is higher than supply. So when demand is higher than the supply meaning properties that are available, and mainly we deal with multifamily properties in Home Life Green Team here in Sudbury. When demand outweighs supply, the price will rise. And that's kind of what we saw last year. Like I was mentioning, in some neighborhoods we saw 20 to 25% appreciation in terms of multifamilies across the board. And the only reason that would happen is because demand has outweighed supply. When demand and supply are equal, the market goes flat. And because of our proximity to Toronto, which is a large metropolitan area and close to Sudbury, just 3 hours south of us, about 4 hours south of us, we have lots of investors coming from out of town and just increasing the demand enough that the supply just isn't enough, and there aren't enough properties for sale to meet that. So these same people are willing to fight over or pay more for the same property. Intermediate, again, because you're mostly relying on appreciation mixed with, you know, improvements. I'll write improvements here. But the improvements in this case are not to increase the value short term. They're hopefully to get a better rental return, right? So you wouldn't put marble, or hopefully you wouldn't put marble countertops and a brand new $20,000 kitchen in each unit that you make. And why am I saying that? It's because you can't necessarily get higher rents for that, or the amount of rent differential would not justify it. So improvements in this case needs to have a caveat because it's only to improve rents, because you're relying on rental income for your return here as well as appreciation. Those two are equally balanced. Here it's mostly just forced appreciation. Forced appreciation meaning the market didn't cause the appreciation, we caused it by improving it. Rental income plus appreciation. Appreciation is what causes our profits in the intermediate term. So that's the caveat on improvements. They are important if you want to get the maximum rent out of a property. You know, if a 2-bedroom here in Sudbury rents normally for $1,250 or more, $1,250 to $1,300, even sometimes upwards of that. If it's currently renting for $700, it means that it's not in the best condition. You will need to do improvements because $500 a month, you know, $6,000 a year in rent will justify on a 5-year basis, will justify capital, putting capital into it. Okay, so another, this, I guess you could see this as a disadvantage. And this is why I consider intermediate the most popular type of real estate investing, or at least when people enter the market, they consider this to be their type, is because of the leverage possibilities. So I talk about this in almost every video I do, but one of the benefits of real estate is the leverage that you can use loans to accomplish. So if I pay 20% down, that means 80% of the property is financed, and that's leverage, right? It's like using a lever. I pull it over here, and I'm able to lift something much, much heavier than if I had just lifted it with my hands. So that leverage enables you to buy and buy and buy more properties very quickly. You know, doing improvements, again, to raise the rents, because one of the three valuation techniques of real estate property is the rental, is the cash flow. It's called the cap rate technique. So if you can raise the cap rate, which we've talked about in other videos, so you can go watch that one. If you raise the cap rate, the value of the property will increase proportionally, which means your equity, which could go from 20% to 30% very quickly, that leaves you 10% for you to go to the bank and say, will you give me a loan on another property? I have all this equity that I'd like to use as a down payment on another. So that's the great thing about real estate. And you don't really get the benefit as much in the short term from this kind of leverage. In the long term you do, and in the intermediate term you do. And I think leverage deserves its own video. So we'll leave that for another time. Now let's talk about mortgage. So the most beneficial mortgage type when you're talking about intermediate would be a floating. So why is that? Typically, a floating mortgage is going to be a few points lower than a fixed. The benefit of a fixed, obviously, I put greater than, meaning it's better. But I guess if the rate is lower, then it's better. Anyways, I think you understand. So a fixed rate mortgage gives you kind of the peace of mind knowing that every single month your payment will be the exact same. But typically a floating rate, because it gives more flexibility to the bank, the rate will be lower, so the amount of interest you're paying will be lower. So I would recommend a floating point mortgage, unless, for intermediate investing that is, unless you suspect that in the next 3 to 5 years, which is usually 5 years as a mortgage term, unless you suspect that the interest rates are going to increase. So interest rates are at, all-time lows right now. You can get a loan sometimes as low as 1.7 or even lower. With a floating rate, that might turn into 1.6, which over 5 years could turn out to be a little bit of money for you. Whereas if you suspect that interest rates are going to rise by a factor of 2, you're going to raise to 3.5, it would have been better to just lock in at a 1.7 rate with a fixed. Even though it's not quite as low as the floating, you're still going to be locked in at 1.7 for 5 years, and you don't have to pay that higher rate. So that's kind of to give you a short kind of view of why you'd want to pick floating for intermediate term investing. Let's talk about long-term investing, and this is probably going to take the longest to explain. This video is getting long, so I'll try and be kind of fast. So like I said, long-term investing is anything over 5 years. 5 years is kind of the key because, like I said, that's the length of a term of a mortgage. And if you're really into finance, or if you've done finance at university or even high school, I guess they would teach this, you know that a mortgage would be split up into, or a 25-year mortgage would be split up into 5 terms. That's 5 terms. So they would call this the amortization period of 25 years. And then each term would be 5 years. So why is this considered long term? It means you've hopped your first term, you've existed past your first term, and you're going to live out the loan, essentially. If you sell after 10 years, quite a big chunk of your mortgage, because you're paying principal on a typical mortgage, will be paid off. And a good chunk, like I said, a good chunk could be 30% of your mortgage by the end of 10 years, which is just, if it's a larger property with many rental units, that could be a serious chunk of money, and you might want to take that equity like we talked about here, you started out with 20%, but now you've got 30 or 40%, you might want to take that equity and invest it in another property. But with long-term, typically the play is to keep the properties that you get and not sell them at the end of a 5-year period. So typically, I know I'm saying typically a lot, but office buildings are a great play with long-term investing. Why do I say that? Well, first of all, in our office, we mostly deal with residential properties. But if you're thinking of doing real estate investing long-term, something like an office or a strip mall would be a great long-term goal. You obviously wouldn't buy this right off the bat because a 25% down payment on $1 million property would be $250,000, and most people don't have that in cash. So this would be more of a long-term play, right? Keeping something well into your adulthood. If you buy it at my age, I'm 26, if you buy something around 30, because you've been investing through your 20s, you buy an office building at 30, you could keep that potentially until you're 50 or even older, and that would just pay dividends for years and years and years. And that's kind of why I recommend going into more commercial, because an office or industrial are all commercial investments. And there are drawbacks as well. That's not the purpose of this video. I think I would have to just tabulate commercial versus residential in its own video, but I think that's probably good enough for now. So anything offices or industrial or something like retail or even a parking structure would all be considered commercial, and those would be great long-term plays because though the cash flows are typically lower, these are extremely long-term tenants. We have to talk about this in another video, but typically you benefit from something called the triple net, which would mean your tenants are paying pretty much all the expenses for you, and you're just getting a stipend of a few $100s a month from each tenant without really doing that much at all, which is pretty amazing. Okay, so with long-term, what are you looking for? Obviously, you want appreciation. But if you're in it for the long term, the most important thing is not necessarily cash on cash return, not necessarily a return like a percentage, but it would be cash flow. I think I mentioned this at the beginning, or hopefully I did, but with every investment, an important part is the time, how much time you're going to be holding it for. Cap rates, like I said, in Sudbury, a typical cap rate would be around 7%. You could buy something lower and maybe push it up to 7%. 7% would be per year. And without that per year, you don't know what 7% means. If it's 7% every 2 years, that's terrible. That's super, super low. But if it's 7% every 6 months, that's great. That's double of this. That's 14, a little bit more than 14% a year. So with cap rates, cash on cash, we're always talking per year. Long term, you're not so much concerned about the per year. You're just in how much return you get per year. You're more intent on how much cash you're bringing in, the absolute amount of cash you're bringing in. So even if you have, $10 million invested in real estate, for some of us this is like a pipe dream, $10 million invested, that's not in cash, and you're bringing in a cash stipend or a dividend or rent payments, your net operating income of $10,000 a month. $10,000 a month is enough to live quite comfortably. For instance, if your house is paid off, you have no more mortgage payments, you own all your cars, $10,000 a month, $120,000 a year before personal income tax. That's a great living for just two people, for just one person or two people. So cash flow is the most important with long term. What do I mean by cash flow? And if you're confused on what I'm talking about with cash on cash versus cash flow, I actually just made a video about this, and I'll link it probably at the end of the video. There will be a title card. As cash flow goes up, cash on cash return goes down. And again, I'm not going to go into that too much detail right now, but essentially if you have $10 million invested, $10,000 is a very small return. But if that's enough for you to live on, if that's enough for you, then the percentage isn't that big of a deal. A 1%, because that would be a 1% return, or sorry, that would be a 0.1% return, is very, very, very small. But if this is enough for you, then, maybe that makes sense to just have that much cash into your deals. We're not focusing as much on leverage here. We're focusing on cash flow, because as a percentage, once you reach this point of comfort, the point that you're happy with, it's not so much, you don't want to take on as much risk. It's not as much about growing. It's more just about maintaining what you have and paying off whatever loans you still have to pay off. And that's kind of the key here, is the goal with a long term is to pay off your debts. Because as you pay off your debts, as we learned in another video, we have net operating income minus total debt service. As the debt service shrinks, your income just becomes the NOI. And this is the cash flow formula. So we want to get to that NOI. If we have the building completely paid off, we get the highest cash flow. So that's kind of the whole play with long-term investing. What are you looking for? You're looking for anything that cash flows. Rentals that cash flow. Probably right in the way. Rentals that cash flow. That's what we're looking for. Anything that cash flows, you want to buy it and just hold it forever. Warren Buffett is the best at this. He loves the S&P 500. He recommends that people buy the S&P 500, which is an index fund, and just hold it forever, because inevitably it will go up in value. If the property cash flows, that means you'll be able to repair it when it breaks. You'll be able to do small fix-ups here and there. And that brings me to my next point. So the only improvements you make on long-term holds are the ones that are needed. Again, similar to this, we're not just improving it for the sake of improving it, because again, we're not planning on selling it. Putting a ton of money just into making the property really nice doesn't benefit us financially. So what we want to do is just focus on what's necessary to get the apartments rented for the most possible. We don't necessarily need to put the nicest finishes in every single apartment, because that won't yield the best results. That won't yield the best dividend. So let's talk about turnover. So the turnover, and I didn't really mention this in the other cases, but turnover is highest in the short term and lowest in the long term. Turnover, what does that mean? It means how many properties you're buying, how many are you selling per year, right? Turnover, like a wheel going around. In this case, we have zero turnover because we only just buy. We only just buy and then we hold. With this, our turnover might be 5 years. So even though you own 10 buildings, each one is at a different point in its turnover stage. And with short term, you might have 10 properties, probably not, because that's a lot to juggle in just 1 year. But some people are doing that. So 10 properties a year, your turnover would be 10 per year. In this case, your turnover would be maybe one a year, right? Or maybe 2 a year. If you own 10 properties and you're selling them every 5 years, that might be 2 a year. That would be your turnover rate. We'll probably do a video just about that. So finally, I know I kind of muddled up my list here. When you're looking for mortgages on long term, you're looking for fixed. Why is this? Because nickel and diming the bank on paying a little bit less interest now is not going to help you, because really you're looking for cash flow, not as much saving on costs because you're going to sell. Because long-term holders are going to hold forever, or at least hopefully, they don't care so much about how much I made this month versus last month. While they do care about cash flow and that the cash flow is positive, we're not focusing on return. So paying $100 more for a mortgage this month isn't going to break the bank like it might with a short-term flip or something like that. And that's kind of the gist of it with long-term, is that you want to focus on paying off your debts which is another way of saying minimizing debt. And I am terrible at writing this way, so I won't bother. You want to focus on paying off the debt, increasing cash flow, and minimizing risk. I guess that's something I should have mentioned, is that risk and reward, sorry, I kind of messed up the equilibrium here, are always in equilibrium. They're always in equilibrium. Why is this? And maybe I'll make a video on this, but this is less to do with real estate specifically and more to do with just economics in general. If someone told you, I have a 100% guaranteed way to make $1 million in 1 year, you'd probably say, okay, first of all, it's not 100% guaranteed. And second of all, it's probably really, really risky. The only way to make $1 million a year is doing something that is very risky in terms of investments, right? And I say $1 million per year. For this guy, $1 million a year is totally doable because he has $10 million invested. For someone like me, whose net worth is still in the 6 or the 5 digits or the 6 digits, making $1 million a year is just the only way you're ever going to get that. It's extremely speculative investments. Things like Bitcoin is very speculative, right? It's very risky. And people might say, oh no, Bitcoin's definitely going up. Well, with something as speculative as Bitcoin, you have to realize that the risk is always proportional to the reward. If Bitcoin increases 20% this year, that means that it's just as viable to go down 20%. And that's kind of the point. When we're talking about risk versus reward here, short term, in terms of reward, is typically the highest. And why is that? It's because time plays a role. All of these are going to pay large returns. And again, I already mentioned this, but I will go over it before we end the video. If you made a 10% return here, 10% return here, and a 10% return here, but this one is per month, and this one is per year, and this one is per 10 years, which one do you want? Well, from that alone, you want this one. But again, the risk is higher. And if you look at people like Dave Ramsey, who lost everything in his 20s, basically betting on real estate by doing short-term investments, buying property at a low price, flipping it. When the market took a dip, he was unable to sell his properties for what he got them for, and he ran into a lot of problems because he was doing zero or very close to zero money down deals. He lost millions and millions from his portfolio. So again, this is the riskiest, slightly less risky, because 3 to 5 years gives you quite a big window. Maybe appreciation will catch up, even if you lose on the short term. And then obviously long term is going to be the lowest risk. The reason for that is if you ever run into trouble, you have so much sunk into your investments, so much equity, that you're always going to have something to fall back on. And you can always, if you run into trouble, a family emergency, or you just need an infusion of cash, you can always sell one of your properties because you have so much equity built up that equity will, carry you on as long as you need it to. Hopefully this was clear and gave a good explanation of short, intermediate, and long-term investing, the benefits of all three of them. This wasn't really a technical video like some of my others with calculations. This is more just to show the benefits of each. And hopefully you guys enjoyed that one. Again, I'm Zach from Home Life Green Team here in Sudbury, and have a good day.